Okay, we're going to get the recording going. Kill just a little bit of time while it's clicking off. So the screen will come up on time. So good morning. Welcome everybody to the How to Make Money Trading Stocks webinar that we do every Friday at 10 a.m. Or you can, if you're on the mailing list, you get the notification where you can catch the recording. Want to welcome both Michael Bishop and Michael Traeger who have joined us today. Good morning, Mikes.
Good morning. Good morning.
Hello, good morning or good afternoon for me, but
So I want to remind everybody that all the materials that we do present here are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. And then for Michael over here, this is a European disclaimer, and it says a lot of the same things, but it also, it says that it is not a solicitation or an offer or anything like that to do services, and we're just here as a team for educational purposes today. So one of the things that the Active Trend Traders, as you all know, I'm very big into training. We had a really good training session on this past Tuesday night. The next training session will be on February 9th. And what we'll be doing, we'll be doing a review of strategy 2, which is the basic option strategy. With the way the market has been acting here of late, everything is just accelerated a lot with regards to how long you hold things, and options are a way to trade those, and we'll be talking a little bit about that on the basic options review of strategy number 2. Anybody wants to get in touch with me, here is my email. So busy week this week, guys. One, is this the new plunge that we're seeing unfold in front of us? Will it be the third leg down, which could be very, very interesting. And of course, there's the bull predictor. That has an 80% over an 80% accuracy rate rating, and what that is if an AFC team wins the Super Bowl this weekend, that would be the Denver Broncos, then 80% of the time the market has gone down after an AFC. And somebody's saying, no, the Panthers are going to win. And
how big is the sample size?
They've been doing the game for 50 years. And so this is Super Bowl number 50. And what really freaks me out and scares me to death is that I remember well watching Super Bowl number 1. And yes, there may be some correlation, but it is questionable whether there's any causation on this. You guys want to talk about the Super Bowl factor in the market, guys?
No, I just want to know who the teams were, if you remember, in the very first Super Bowl game.
Well, that's very easy. It's Green Bay Packers and the Kansas City Chiefs.
All right, I knew Green Bay was one of them.
Yeah, and then the next year they had a rematch, and so, yeah. So S&P, which way do I go? S&P is holding up a little bit better than the other indices. However, it is in a questionable, it's bumping up against some support that we'll see here shortly. If that support fails, then we may get a retrace. NASDAQ 100, it's looking like it's going to do a round trip all the way back down to 4,000. And the Russell, the big question is it going on to a deeper dive? Outside influence and earnings, how many watched the LinkedIn earnings or saw the after effect of the LinkedIn earnings? Very amazing. It's one of the reasons why if you do not have a significant profit, over 10% in a particular entity, I personally don't think it's a good idea to hold that position through earnings unless you know how to protect yourself with certain types of option type strategies. But the usual suspects: oil, China, U.S. economy, Bank of Japan going to a negative interest rate. The big question is, has anything really changed? This morning on the economic front, the jobs creation was below expectation. Last week, it seems like, it just depends on how it's interpreted. Last week, that bad news seems like it would have been good news and the market would have sprung up. However, that didn't happen today. And while we've been talking for the last about a week and a half, 2 weeks about the aspect of price action did revert to the mean, but it was a very weak reversion to the mean. And I know, Mike, you're really big on reversion to the mean issues. What does it tell us to have such a weak reversion back to the mean?
Well, I mean, what it says to me is that, we're in a downtrend, and in any downtrend, if you get too far away from the moving averages, you're going to get, at some point, a bounce back up to them. But, just when you get just a very light touch, like we'll see when you go to the weekly charts, and it just turns around and then pulls right back down, that tells me that the downtrend is still very much in force.
Yeah, without a doubt. And because it was, we were talking about that last week. It was going to push up, but as you said, it's the downtrend, the pull of the downtrend. Just think about it kind of like being like gravity. The pull of the downtrend is very much in force, and LinkedIn just dropped to $80 down from where it closed yesterday.
Yeah, it's about a 40% move overnight.
Yeah, absolutely amazing. You and I were talking a little bit earlier, Mike, and it has lost over half of its value from its 50-week high.
Absolutely true. What was the 52-week high on LinkedIn?
It was about 280-ish.
280-ish, and right now it's down around, what, 111, 112?
Yeah, just sitting right down between 111 and 112.
Well, that's more than 50% off of a 52-week high.
Yeah. And so here's where we were last week, where you were getting a little bit of a push up, and then price actions had bottomed down here at 0.5. This is on the percentage of stock above their 20-day moving average on the NYSE. This week we see a little bit of congestion start to take place. We get here's a pullback, a pop up, and today we're getting what this would be a bearish engulfing pattern on yesterday's shooting star type pattern. That's one thing I do like about candlesticks, is they can be utilized on anything that you can chart. And so if we close today approximately where we are right now, and the buyers do not come back in to support the price action, this would be telling us that we're probably going to roll over, move back down. How far down? That's the big question. We don't know. But as we see here, this line of basically resistance held, tried to stick its head up above it to rally higher, and then has in fact fallen from there. It has been a very challenging time to be a stock buyer, simply because of the price action we've been seeing on the indices. And Michael, over in Switzerland, are people leery about getting into any long positions right now?
It gets scary more and more. I think especially bad was the performance in Germany, but also Switzerland has already tested this new year's low.
Yeah.
And there are, so definitely an anomaly is that the Swiss franc in value decreases to the euro.
Yeah.
So typically, if there is a crisis, then Swiss franc goes up. So that could be kind of an alert that I mean, and Switzerland is really, I think, was one of the stock markets that is most overrated, especially last year.
Okay.
The growth is very low. I mean, they have some very good quality stocks, but they have no big growth perspectives.
Okay.
And are valued like growth stocks. So no, it looks scary, and I mean, but I had a long discussion with an experienced private banker, and she seems to be really scared now. And that's kind of a typical market that, I mean, I would be surprised if we don't see a quick short rebound rally in the next weeks.
Okay.
Especially, I know we are oversold now, but really short term.
And so, and then here is the percentage of stocks above their 200-day moving average on the NYSE. And as we can see, last week was up about 21%, but it has fallen down to 19.09%. I think it's a little bit lower now because of the continuous sell-off. Yeah, Mike Traeger, I mean, this is really telling us that in the internals within the market are just really weak at this point. I mean, with this few stocks actually above their 200-day moving average, I mean, is it pointing to a, you know, does it strengthen the case that we could be rolling in for all of the indices to go into a bear market?
Well, yeah, it certainly strengthens the case. I mean, this particular metric now is at, you know, levels that it has reached before very strong rallies in the market over, you know, the past 8 or 9 years. And but, you know, it's been living at these levels now for several months, and it's just nothing but an indication of real fundamental weakness in the overall U.S. markets that isn't necessarily reflected, you know, as we've spoken of, you know, repeatedly, in the you know, cap-weighted indices that we commonly follow.
Yeah, yeah, and so yeah, and one thing that that I think this chart does a really great job of doing is it shows us, you know, exactly when the weakness. Hold on a second, please. It showed us when things started getting weak, and that was basically back here in, you know, midsection of 2013, where a lot of the stocks started, you know, underperforming. And we'll be taking a look at a chart here when we look at the indices, the non-weighted ETF for the S&P, and you'll see how that has definitely been a underperformer. And in fact, well, I'll save that for when we get to that chart. Good stuff. So here's where we sit today. The Russell is definitely pushed back down, and it has maintained its being in a bear market. The Nasdaq has dropped off today. S&P held up, you know, about, well, it's down from where it was last week, and then the Dow is actually held up just a little bit better, and I think that's partly due to if people are looking for stocks to invest, they want to looking for them to pay dividends, and also so some of the flight to quality, or what they call quality, could be, or flight to safety, I should say, it puts people going back towards the Dow type stocks. One of the things that's really other interesting, we'll take a look at the Nasdaq Composite also. It is down more than the Nasdaq 100. And so, yeah, BJ, on the last chart that we showed, there is some websites that allow you to do that, where you can overlap the S&P with the percentage of stocks below their 200-day moving average. So let's see. So let's go look at the charts.
If you want the name of that website, for whoever asked that question, the website is indexindicators.com,
Yep.
and you can do that there.
Yep, and that way you can throw in comparisons of how the individual indices are doing against it. So let's look at the S&P here, and this is on a daily chart on the left, weekly chart on the right. And what are we seeing here is basically we get this our relief rally pushed on up into here, right up close to the midsection of the fib box, which is the 38.2 to the 61.8% retracement, hit just shy of the 1950 level, and then it has rolled over the last couple of days. It came down, retested this 1875 level on Wednesday, and did a nice little rebound. But on this rebound, it was weaker, and it couldn't get much above the 20-day moving average. A question came in from one of our members. He said, with these sequential hanging men, was that an indication that the market was weak? Well, this is the only candle that is really close to a hanging man, and then it went into a slight downtrend and actually put in a hammer. But a hammer is a bullish reversal signal. But only after, they tend to work better after they've been in a more significant downtrend. And a one-day downtrend, I think, taints the value of the hammer. I mean, it's telling us, yeah, we found support here, we rebounded, but then dropped. And today, the market just, it kind of paused, but then fell. One of the things that I always am interested in is we're pushing down here towards this 1875 level. At this point, the daily momentum is actually ticked up a little bit. And so so it's out of sync with what the price action is doing. Longer term, we've got the momentum on a weekly chart. Pushing up, it is starting to move up. We have got a level of positive divergence going on the weekly chart on both of these, on both of these oscillators. I didn't want to do both of those, which that could be indicative of we're going to go back down into either, if this area fails, we may push down into this level here and then bounce. And it's not, well, yeah, it is. It is positive because this, let me draw this down real quick, because when we hit this low here, was right about when this bottomed here on the true strength indicator. So, Mike, would you agree we have a little bit of positive divergence on a weekly chart?
Yeah, I'm not so sure.
Okay.
I'm not so sure. I mean, yeah, we've had a little bit of a rally here the past couple of weeks, and we've had a bit of a rally in the momentum indicator the past couple of weeks, but I think that divergence might have been applicable a couple of weeks ago.
Yeah.
I don't know that it's applicable now.
Yeah, because one of the other things we got to take a look at is this could just be a rally back up into the zero line on both, slightly above the zero line that we see back here in the past, and then the price action then did in fact roll over and fall from there. And so we know we do have strong support on the S&P at the 1875 level, and then we get down here between the about 1917 or so, 1817 to 1825. There's another support zone where things could bounce from there. But if this 1850-ish level or 1866 level does break and we get a close below it, you can basically take this cup structure, inverted cup structure, measure from here to here, and then extend that down, and it's going to take you right down here into that level. So let's take a look real quick at the RSP. Excellent. And if you'll remember on the S&P, well, let me go back to the S&P real quick, SPX. The SPX from its 52-week high down to this low here was about 15%, correct? And so, but the RSP, which is the non-weighted ETF of the S&P, if you go back and measure that same high down to this low, this is not weighting anything. You sit at 19.5, a little bit over 19.5%. So what that tells us is the stocks within the S&P, if they weren't weighted, it would have approached and came very close to being categorized as going into a bear market. That weakness is a real issue, right, Mike?
Well, yeah. Actually, I think the S&P 500 from high to low, 52 weeks, was down about 11 or 12%, not 15. But the non-weighted index is down nearly 20.
Yeah.
And Wall Street wants to define a bear market as a decline of 20% or more, which is really, it's a pretty arbitrary definition, but it's one that everybody uses. Well, what does this tell us? It tells us that, the S&P on a non-weighted basis, pretty close to being in bear market territory. Yeah. We know that the Russell is actually in bear market territory, and but whether you want to use that definition or not, the point is it's a pretty significant correction, pretty significant downturn. It's been a long time in the making. And the question is whether we're going to be done with this correction fairly soon and bounce back to new higher highs, or whether the correction has more room to run.
Yeah.
History would tell us, and I know that you looked at this earlier, Dennis. History would tell us that potentially we have more room to run to the downside.
Yep.
And I personally find it highly unlikely that the highs that were put in last year in the cap-weighted indexes, like the Dow and the S&P and the NASDAQ,
right,
I seriously doubt that we're going to be revisiting those highs anytime soon.
Yeah, because one of the other definitions of a bear market, of course, is and when we say bear market, I mean, I hate to use labels, but it's label that they've been using for hundreds over 100 years. But when we talk about a bear market, it's not to say that there won't be long trading opportunities during that period. Matter of fact, Mike, we talked about this on Tuesday night. Some of the largest rallies on the indexes actually came during a relief bounce off during a bear market. And
yeah, that's absolutely true. In fact, 6 of the biggest single-day advances in the history of the stock market happened in 2008 and early 2009, when we were in the midst of a very strong bear market. In fact, I think in October 2008 there was one day when the S&P and the Dow went up like 10% from the previous day's close.
Yeah.
And that's non-leverage. That's just the index. I mean, a 10% move in one day. You know, if that were to happen now, that would be like 1,600 points on the Dow, which is inconceivable. But that was right in the middle of all that turmoil in late 2008.
Yeah, and what we're seeing, you know, and to kind of put this all additionally into perspective of maybe when we're a little bit, you know, it's not necessarily gloomy because we are taking, you know, steps to trade various strategies that allows us to still be in the market, making some, you know, good cash flow and that kind of stuff. But the concept of at this particular point of doing the portfolio building, you know, is just, you know, it's something. Those are cards that just aren't on the table at this particular time. So the NASDAQ, what I'm looking at is, okay, if this 4,000 breaks, then we're probably going to bounce down here to 3,800. And by that time, you've got a nice bigger pattern, rounded top. Let's take a real quick look at the, hopefully it'll come up. There we go. This is basically the monthly chart here. Those moving averages are starting to tip. This longer term, this would be the 20-month moving average, has started to roll over. And as you can see over on the weekly charts, we've already had some what they consider some of the death crosses, or a death cross on the NASDAQ 100, which typically means that we are moving and the path of least resistance is down. I think you can see it best on a monthly, on a weekly chart, is that we got the proverbial bounce up, even though it was all in 1 week. We get a down, a bounce up, and then a fail this week. And if we take out this 4,000 level, then we're probably going to bounce to here. If we take out that level, we're going to bounce to here. And if we, I'll just do a real quick extension here, put in a trend line from here to here, this level here. And if I take this trend line here, activate it, move it back down, look how close that comes to hitting, because typically if you do one leg down, one leg up, second leg down, will be about the same magnitude as this one. Look how it takes you right down here to the 36 level. Is it going to happen overnight? No. Will there be, you know, but those are the pictures that I'm kind of seeing on the charts. So let's take.
You know, to me, the most striking observation on the monthly chart, and I think this is why it's good to occasionally step back and look at longer, you know, longer time frames.
Yeah.
There's not much technical, you know, damage here at all on the monthly.
Yeah, exactly.
Despite all the volatility and, you know, people, you know, wringing their hands about, you know, how January was terrible, you know, that monthly chart looks more like a price consolidation around a high than anything else.
Yeah.
And, you know, certainly you don't see the kind of thing that you saw in 2008 or 2009, at least not yet.
Right. And so.
Very well said. I totally agree.
Cool.
Yeah,
so let's go.
That's the point.
It's Russell, the weakest link. Again, yes, it is the weakest link, but it has a strong level of technical support here at the 985 level, which it is again testing today. If it drops that one, we're going to probably drop to the 958 level. And here's what we need to remember that, okay, we've tested at the 20, it's rolled over and has dropped back down below the 8. And so oftentimes when that happens, we'll look for, and what's going on here is that the TSI rolled over at the 0 line, which is typically an indicator that there's going to be more downside. We do have a negative cross now, and so it needs to roll back down, and we see what happens with that. It's got a fairly predictable time frame of number of days from highs to lows, and so this is looking like a sine wave, and we can utilize that to project out where, you know, time-wise, where the next potential bounce will be. Now, can it flip back up and just say, hey, I'm, you know, fooled you, Sure. That's always one of the risks we have going on in the market. But the Russell seems like it's settled out a little bit. If, for whatever reason, the Fed comes out and says, you know what, we really, messed up by raising rates in December, because I could see them making that kind of confession, right, Mike? And, but if they came back out and said, we're not gonna touch rates for this year, we're gonna let the economy settle out, that could in turn lead to a significant rally in the Russell, which is more affected and impacted by the rates on the indexes, our rates from the Fed, and it could happen.
But yeah, but somehow I don't trust the Fed to come out and admit that they were wrong about anything.
Yeah, that's the truth, and because it definitely seems like that the Fed is out of sync with other national.
What, the other central banks?
Yeah, the other central banks. And so it's kind of interesting how that's going on right now. So that's it for the Russell. Let's get back to any questions on the Russells, guys. Okay. Here's the chart that I was reading, and a matter of fact, I forwarded this out to members. It was an article in I think it was Yahoo Finance, and I thought it was very interesting. Since 1929, I wasn't around back then. This is 1929. There have been approximately 13 bear markets. That's corrections of over greater than 20%. Here you can count them. A couple of the interesting pieces of that is that bear markets tend to, on average, be about 18 months in duration, but that can vary. Here's, 3 months bear market dropped 31%, all the way up to the largest one was, I think right here, 49 months back in the 1940s, and it dropped 38%. And then the other question, we anticipate, well, if a bull market is typically about twice as long as a bear market, then you would expect a bull to last at least 3 years. Well, that, you can say, okay, yeah, so, at the 3-year mark, we start anticipating the bull, dying, but in reality, the bull can last for 166 months. Here's 114 months, 145 months. There was one that lasted 61 months, and so 83 months on the current bull market. So they can in fact last a greater amount of time than just the straight average of 3 to 4 to 5 years. And but I found this chart very interesting. Not so much from the aspect of, hey, we're due to roll into a bear, but it just kind of helps to get things into perspectives. Mike or Michael, you guys got any comments on this chart?
Well, my only comment is that, yeah, it does provide some perspective, and I think in just broad brush strokes, without getting too hung up on the individual examples here. Bear markets happen. I mean, the nature of this stuff and the nature of the economy in general is cyclical. Rule of thumb, bear markets tend to lose on average anywhere from about 30 to 35%, and they generally tend to last for around 12 to 18 months.
Correct.
Bull markets tend to last for maybe 3.5 years on average, and will certainly make back more than the preceding bull market lost on average. And just some basic general guidelines to keep in the back of your head. The bull market we've enjoyed since 2009 is historically one of the longest ones that we've had.
Yep.
and certainly went beyond that 3 or 3.5 year average. And not to say that that's unprecedented, but it's kind of unusual. And you know, a downturn at this point, if that's what we're experiencing, or you know, beginning of more downside to come, it's just a normal part of the cycle.
And so, without a doubt, Michael?
Yeah, totally agree. Really good summary. Okay. I just one other interesting little study I read is that what can you say after a day of a big movement? And the result was very clear that it's still a 50-50 chance the next day, up or down.
Yeah.
But it's a 75% chance that the next day will also be a strong move.
Ah, okay. Yeah. I think we've been kind of seeing that kind of play out here of late, is where you would get one big down day. It would close at near a session, you know, near the session lows. The next day you get just a reversal, and it is almost the mirror image to the upside, closes close to the highs, but in reality, over the 2 days, the net is the stock has gone, the price has gone nowhere. So Bruce brings up that on this chart, on the article, if you did get a copy of it, you can basically, if you read the text with the chart, they expand the down market to highlight how much you would have to make back in order to get back to even, which is a very important aspect. And that's why I believe in, one of the reasons I believe in market timing. So now this is with the weakening of the dollar. Michael sends this picture from Europe, and the question is, how many 1 cubic meter boxes do you need to store 1 billion US dollars? So Mike, you want to talk to this Michael, you want to talk to this real briefly?
Yeah, well, it's pretty easy. So obviously, so in Swiss franc we have a 1,000 bill, and at the current valuation of gold, this is more effective or needs less space than gold.
Okay.
And I mean, the question is not that ridiculous, because with negative interest rates, I mean, if you are allowed to take cash, then it's an alternative option to your saving account.
And so, and then it goes all the way up to euros number 3, and this is the Danish krone, US dollar.
In Germany they discussed to abolish the 500 euro notes.
Okay. Hey, I got a question for you guys. Speaking about negative interest rates, and just a real brief question, is when a central bank like the Bank of Japan just recently, last week, reduced their interest rates that they're doing to a negative number. In other words, the institutions that utilize the central bank have to pay the central bank for them to keep their money, basically. You guys got any insight on that? That concept of negative interest rates, and how they work out within the broader, both global and U.S., maybe in the effect on the U.S. economy?
Well, I think my observation, historically, I think negative interest rates are without precedent. I don't know that we've ever had negative interest rates any time that I can think of in history in the past couple hundred years, and probably further back than that. I know what the theory is behind going negative on interest rates, but how it plays out, because we have no frame of reference for that, and no previous examples of that, I think it's pure conjecture as to how it's going to play out. But we have one current possible example in Japan, which hasn't really been negative for the last 25 or 30 years, but it's been really low and just right down around zero. And just in terms of equity markets, I mean, after repeated incidents of quantitative easing in Japan and decades of historically low, probably negative real interest rates, meaning interest rates adjusted for inflation, have been negative in Japan for quite a while, and their stock market reached a high level in 1989, I believe, that has not come close to getting back to.
Yeah. And so, what about Michael? Are there any I thought some of the central banks in Europe were doing a negative interest rate right now.
Yeah, definitely. Switzerland, since a year, -7.5%. I mean, the consequences is for the retail investor, so the local ones, they up to now kept it to 0%, but they are creative in charging you some accountant fees.
Yeah.
And it's really bad and challenging for the pension funds. I mean, they really get affected by this. And what do? They flee into stocks, and so they pumped up, as I said before we started the conference, Swiss quality stocks, and they have been, I think, really overvaluated end of year, and now we have a correction that is a little bit stronger than the US currently, and I think technically it looks worse.
Well, and the negative interest rates in Switzerland and some of the other European countries, I mean, in the overall scheme of things, it's been relatively recent.
Yeah.
And I don't think we know yet how it all eventually plays out.
Well, Mike, you hinted at the theory behind it. Can you just briefly hit on what the theory behind going to negative interest rates is?
Well, the theory behind it is, the central banks want the commercial banks, to pump money into the economy in by using the mechanism of loaning money to businesses and consumers, who will then borrow money and go out and spend it and try to drive the economy that way. And so by making it by making interest rates negative, they're trying to provide an incentive for the commercial banks to not keep money on reserve with the central bank, but to go out and put it out into the economy. But the other part of that dynamic or that equation is the willingness and the ability of the businesses and the consumers in that economy to want to keep on borrowing money and taking on more and more debt. So the theory is, don't keep your money parked at the central bank, loan it out.
Yeah, let your money get out there, and that would be like going to Wells Fargo and saying, okay, Wells Fargo, don't leave your money with us, get it out there into the community where it can do the most good.
Yeah, that's the theory. The reality is, again, the willingness or the ability of those potential borrowers to just keep on borrowing.
Yeah.
And that's where the reality begins to not necessarily jive with the theory.
Yeah, BJ basically says that he believes that the negative interest rates issue with the central banks is a tiered type approach, which I agree with that. Is that the first tier is not negative, but then you get to the second tier is break even, and the third tier is in fact negative to some of their biggest customers. So interesting.
Yeah, well, the biggest customers are the big commercial banks that are required to keep a certain amount of money on reserve with the central bank, but they're trying to dissuade them from doing that by going negative on whatever interest rates they would earn on those deposits with the central bank.
Okay. So moving on, path of least resistance. I'm going to do a quick poll. Is everybody awake? Okay. If you believe the path of least resistance is up, please raise your hand. Oh. If you believe the path of least resistance right now is down, please raise your hand. Wow, that almost filled up the whole chart, guys. So from the members who are online, they believe that the path of, now Michael mentioned about a potential bounce. Yeah, we are sitting very close to a strong level of support on the indexes, on the individual indexes, and we could in fact get a little bit of a bounce. But for right now, that this as it tries to get back up to the means, which it did a poor job over the last couple of weeks. I mean, it came close, but so yeah, I'm looking for right now that the path of least resistance is down. But at the same time, if proven wrong, which we will know by how the moving averages and how the price action works, then we won't have a problem with switching that back over with the path of least resistance being up. I know IBD had the market in an uptrend or a confirmed uptrend. After today, it may be back to that the uptrend is in trouble. Here is the cash we have pulled in so far this year, just as on closed trades. And then what's happened is here's where we're sitting on the equity curve. And this is both closed and open trades. And what we had is with the two strangles that I have open, one on Tesla, one on the S&P, are the spiders, is with the falling prices, the value of the put side of that strangle has increased dramatically. And so that has driven the overall value of the account up to a little bit over $3,200 up through the first 5 weeks of the year. So this month, monthly meeting with the Bay Area money makers and San Jose tomorrow. If you are in the Bay Area, please come down and join us. We start at 9 o'clock, and it's at the Masonic there in San Jose. We've updated, and most of you have seen the update on the early warning from last year, back tested. I have completed now the back testing on the active trend trading in EW for the aspect of downside trades. I'm working on getting the report worked out and sent out. And then the getting started video is online. I want to remind everybody that I believe and I utilize the 5 pillars of active trend trading. With the active trend trading system, and it tells us what to buy, where, when to, what to trade, quality IBD growth stocks and or index ETFs, when to enter, when to exit, what strategy to use, and then what our expectations are. All of our strategies are based on and have the foundation on the active trend trading system. And again, I have been very thankful that the wealth, and this is where I have a leaps on both the S&P and Tesla, with the funkiness of the actual market. Selling weekly premium has worked out very well, and so I'm glad I've got that third strategy, number 3, to fall back on while I'm waiting to be able to start building a portfolio. So if you are listening to or watching the recording of this, and would like to become a active trend trading member, we have a limited time offer here, 40% off the regular monthly price, and on the early warning alerts, it's better than 60% off the yearly. You can find that at this website here. So see you next week. We're going to be looking at some stocks if you guys want to. And if you are a Super Bowl kind of person, okay, just real quick, and one more survey. Who is rooting for Carolina? Show of hands, please. Okay. Who is rooting for Denver Broncos? And who doesn't care? Okay, Judy's going, and Tracy's going, what's football? So anyway, should have some fun time. My sentimental favorite, not because I want the market to continue falling, but my sentimental favorite is Denver, and I'd like to see Peyton Manning go out on a winning note. But I won't lose any sleep regardless what happens. So with that, Michael and Mike, thank you so much for joining us. And I hope you all enjoyed kind of the flavor that Michael Bishop from brings, and then Mike Traeger, the information that he brings. Both guys are very knowledgeable in what's going on in the market. So I have time to look at a couple of stocks because I have to get ready for tomorrow's Bay Area Moneymakers. And so is there a stock you want us to look at real quick, folks? Here's a stock that come on. Here's a stock that I really thought that I wanted to be in, but it's going to have to do a little bit more consolidating here. Facebook had a real huge buying to pop it up above and break out above the 110 level and the 107 level. And we were anticipating that it would pull back to the 110 and then, or maybe the 107 level, and then bounce from there. And in fact, it did not bounce today. It continued to sell off. It is selling off to the 50-day moving average. We'll see what happens there. But as you can see, over the last 4 days, actually, you have selling coming into Facebook above average selling. So let's take a look at AVGO. AVGO is, let's see, earnings are past, and we are getting a move back down below the 50-day moving average. Excuse me. So is it shortable? Yeah, Jonathan, I mean, if we can get back below the 200 here, or if we do a retest up around the 50, that's where I would look to go short, but it's looking very weak. Would like to see a little bit more selling volume. That would say, hey, yeah, go ahead and get in. If you did buy off today's signal, breaking below the 50 and the 20, it is at a level of support. So it could ricochet back up on you. And so right now we'd be looking for it to break this level of support that is held for the last couple of days and where this gap window is. And because that whole gap window is a level of support for it at this point. GDX. Okay, miners, gold miners. With the way the economy is going, Judy, this may turn out to be a very, very good trade. Just from a technical standpoint, it is approached getting back up into where it found resistance, where previous high resistance between the $16.50 and $17 amount. But this is a really nice buying into this entity. And so I would look for, it is extended away from the moving averages. I would look for some kind of a pullback towards it. And if we get across the 8-week crossing above the 20-week, and I would look to start trading it from there. And you can sit there and you can go, okay, about halfway down this candle here, which is there, is a place where you could anticipate a level of support. And you could use that as a temporary line of demarcation for getting long. Looks like that's a pretty good looking chart though. What kind of volume is it doing? Yeah, lots of volume. Would I buy in a intermediate term down or midterm downtrend? I would have no problem looking at buying this because we've got a test here at this low. It retested 3 weeks ago and has bounced back up. And so it looks like it is in the process. This is almost like a classic double bottom type move, which is basically a double here, back up, back down, back up. And if it, again, either comes back down here and retest, I would look at buying there, or if we break out above this level here. And then if we do the breakout, then I would be looking for the retest to come back into the 8-day moving average or the 8-week moving average because it is extended from that. So, but and you've also got this level here at about 15, which is where it busted out at that level to move higher. So interesting look. It appears as if it is moving towards a rally. Yes, momentum is moving up nicely, and that's the other thing. Momentum has moved up, and so now we'd just be waiting for some kind of a retest. EVGO, we talked about that. SWKS for a potential short. And that's Kansas City. Yes. Yeah, a couple of ways you can play SWKS to the downside is that if it breaks down below this 58.47 level, then it's probably going to fall because it's got support there at around 58.47, 58.50. Then it's probably going to drop at least to this next level, which is about 44. So the way you can trade this is one of two ways. Is basically if you believe that the weakness is going to continue, the midsection of this weekly candle, which let me draw that with a, so it'll show up on both charts. Okay. Well, to draw it from over here. The midsection of that candle, and you can see where it hits over here. So that would be any type of a rebound back up here into 65. Look for some stalling, or maybe just a single day real quick uptick and then move down. Or the flip side of that would be basically a breakdown here of the level below this candle here. If it drops that, then we're probably going to the 50 or even the 45 level, which is a nice move on a stock like that. So that's the way I'd be looking at trading it to the upside. If it gets past the midsection of this week's candle, I would be looking at utilize that 8-week moving average to give you some highlights of when to potentially go short. And if you went short at that level, you would put a stop loss just above where you went short. Sedge, looking at Sedge, Judy, I'm glad you brought this one up. I'm really liking it. It's holding up well with the market. It basically had earnings. Looked like it was going to break out of this 3060 level, but failed, even though it had really great volume. And so I think that what we're seeing is that the market is holding this one back. But look for potential, if we maintain the upswing, we'll look for it playing off of the 8-week moving average and or the 8-day moving average. But right now and as you can see, it's got resistance. It has resistance right there at the around the $30 level. Cray, and this is the last one. Earnings to 11 after market. And it looks like it is doing a pre-earnings run, Tracy. It may bounce from here. It's holding up fairly well with the market. And as you can see, it's come back and it's tested in the midsection of last week's candle and is now rebounding. Will it rebound enough to take out the upper level, which is at 40? We don't know. But, you know, if it gets back up about 37.50-ish, one could take a look at, you know, that could be a potential buy, or wait till it moves back above the 8-day moving average. Now, what it may do here is do a moving average squeeze, which is basically price action linger around here as this moving average comes back towards this longer term moving average, and then it'll ricochet off, and that's a moving average squeeze up to the upside. You see a squeeze here on this upside move, a little bit of a squeeze here, and then it moves back down, a little bit of a squeeze here, and then it ricocheted and went higher from there. So again, it looks like it is trying to get ready for a pre-earnings run. And I will throw one other one on there, and let's take a look at Tesla. Those of you who are trading Tesla, Tesla is really doing an awesome job of selling off. If you are in the strangle trade, what I'm doing on this one is I'm letting it go. I'm not going to open a position today to cover the short side of the put in the call that I own, the leap call, put in call. What I want to do is I want to wait until we get into next week when the implied volatility on Tesla will go through the roof even more than it is now. And I will be looking at selling a put and a call, a weekly put and a call on Tesla as we get closer to Wednesday of next week. And it's in the past, I've traded Tesla now for, gosh, going on almost 2 years with the same kind of strategy. And sometimes it's implied volatility on the day of earnings before they announce can get up to 150. I think the largest I ever saw it was up at 200%. And so I can go then well out of the money on both sides, collect a and then as soon as it reports, the volatility is just crunched out, you know, squashed out of that, and makes for a pretty good return. So with that, I'll bid you adieu. Have a great Super Bowl Sunday. And if I see you tomorrow at the Bay Area Moneymakers, that's awesome. Have a great weekend, and God bless everybody.